Hey everyone, in this class, we're going to talk about statement of cash flows. And specifically, we're going to first talk about what is a statement of cash flow, why is it used for, and what is the general format of a statement of cash flow. And specifically, there are two methods to prepare a statement of cash flow. One is called the direct method. The other is called indirect method. And we're going to go over in this class how to prepare a statement of cash flow under the indirect method, because that is the most often used method. Let's get started from talk about what is statement of cash flow. In previous classes, we have talked about what is a balance sheet, what is an income statement. Please pause your video for now and try to remind yourself what is a balance sheet, what is an income statement. So balance sheet, if you still remember, what are on the balance sheet? It discloses a firm's how much assets the firm has, how much liability the firm has, and how much stockholders' equity the firm has. And it is basically kind of like a snapshot of a firm at a specific point in time. What is the amount of assets, liability, stockholders' equity? So it discloses about the position of a firm at a point in time. And versus income statement, what do we have there? We have the firm's revenue, expense, cost of goods sold. So it basically discloses a firm's performance during a period of time. So for example, from January 1st, 2021 to December 31st, 2021, how much revenue the firm earned, how much expense the firm occur, and then as a result of those, what is the net income of the firm during that period of 1 year. And then what is a statement of cash flow? So statement of cash flow, it basically reports the firm's cash receipts and cash payment and net change in cash during a period of time. It is different from the firm's income statement in the sense that the firm's income statement, even though it also reports a firm's performance during a period of time, it is based on accrual. It is based on accrual-based measurement of the firm's accounting. Revenue is measured by whether the firm has performed any service or delivered any good, regardless of whether the cash is received by the firm. And expense is recognized by whether the firm has consumed any services, etc. And it is also regardless of whether the cash has been paid. So in this sense, the statement of cash flow, it strictly follows the cash receipt and payment, how the cash is flowing within the firm. So it's different from the income statement. And comparing it with the balance sheet, it is also different. On the balance sheet report, if you remember that one important account we talked about before, which is cash and cash equivalent. And balance sheet basically disclose about what is the firm's cash balance, for example, at the beginning of the year versus the cash balance at the end of the year. So it only reports the firm's balance at a specific point in time. However, it didn't disclose in detail why does the cash change, for example, from 1 million at the beginning of the year to 4 million at the end of the year. What is causing the change? It didn't disclose anything about that. Versus if you look at statement of cash flow, and what we're going to talk about in later, it gives us a much detailed view of what is causing the change in cash of the firm during that period of time. And specifically the causes. So the change in cash can be caused by 3 kinds of activities. One is the firm's operating activity. One is the firm's investing activity. And the last is the firm's financing activity. For example, if the firm has sold any product, it is receiving cash as a result, and that is an example of the cash generated from operating activity. And in order to carry out those operating business, the firm may need to pay workers, and that also goes into that. That is also classified as one example of cash flow from operating activity. That is a cash outflow as a result of the firm's operating activity. And with regard to investing activity, firms may need to buy some machines. They need to maybe purchase some like either fixed or intangible asset. It may need to invest in securities. So those are the investing activities of the firm. And whatever cash flow which comes as a result of those activities, those are classified as cash flow from investing activities. And how about financing activities? Sometimes the firms may decide to raise additional cash by issuing stocks. So that is cash inflow, which is brought in by the firm's financing activities. And sometimes because the firm has stocks, so it may decide to pay out dividend to its stockholder, and that is a cash outflow from financing activity. And then firms may decide that instead of raising capital through issuing stock, it may decide to borrow from a bank. So that is also a cash inflow from financing activity. So this is just in a nutshell what statement of cash flow is. And we're going to talk about it in detail in the rest of today's class. So why is state of cash flow useful? We have already talked about it. The balance sheet, the income statement, it provides some information about the firm, but it's not complete. Like investors, some of the investors may be interested in knowing more about the firm's cash flow, especially those information will be useful for investors and also the firm's creditors, basically the outside users, to predict whether the firm has ability to generate any future cash flow. What is the firm's cash flow generating ability? Usually we look at the cash flow from the firm's operating activity in order to get a better sense of the firm's ability to generate cash from its core business. And then in order to pay out dividend, in order to pay out interest, the firm needs to use cash to pay those out. If the firm doesn't have sufficient cash flow, the firm may have trouble in doing that. So the statement of cash flow may provide us with some information with regard to the firm's ability to pay dividend, to pay interest. And also sometimes investors or creditors may be interested in knowing what is the difference between the firm's net income versus cash flow from operations. What explain those? So if you just look at the firm's income statement or balance sheet, you are not going to get any information which will help you with that. But the statement of cash flow, especially under the indirect method, provide a very detailed explanation. So this is why statement of cash flow is useful. And how does statement of cash flow look like? So we just talked about the change in cash can be explained by three kinds of activities: operating activity, investing activity, and financing activity. And basically, statement of cash flow, basically, it classifies the cash flow according to what activity the cash flow is associated with. So is it a cash flow from operating activity, or cash flow from investing activity, or cash flow from financing activity? And altogether, the cash flows from those three activities, for example, this is A, B, and C. A plus B plus C, that is the net increase or decrease in cash. So basically, that is the change in cash. And that is also equal to the difference between cash at the end of the period and cash at the beginning of the period. And those two numbers should be tied to the cash balances on the firm's balance sheet. So for those two numbers, basically, if you take out a firm's cash flow from cash flow statement, for those two numbers, you should be find exactly the same numbers on the firm's balance sheet. This is basically the firm's cash balance at the beginning and the end of the period. And also sometimes some of the activities the firm's involved in, for example, the firm may issue stock in exchange for a building. And this is a typical non-cash transaction. And on the cash flow statement, sometimes we are also going to include those kind of non-cash transaction at the bottom of the statement. So this is briefly what a statement of cash flow looks like. And here is just some more detailed explanations. So we already talked about it. We have three kinds of activities. And cash flow from operating activity, those are mostly generated by firm's normal business operation, like the sale of goods, provide of service. And in order to do that, the firm may have some expenses, like it needs to pay out workers through salary. It may need to rent a building, rent some machines. It may occur some interest expense, pay utilities, pay tax. So all of those are operating related activities. And the cash flows associated with that are called cash flow from operating activities. The second kind of activity, investing activity, those are usually related to the acquisition, disposition of long-term assets like PP&E, which examples are buildings, equipment, plant, and also investment securities. So, and any cash flow which relate to that, those are called cash flow from investing activities. The next kind of activity is called cash flow from financing activities. Those are usually related to activity with investors, creditors. For example, if the firm issue or repurchase stocks, issue or repay debt, pay dividend, and any cash flow which related to that kind of activities are called cash flow from financing activities. And the last one, sometimes firms may engage some activities that do not involve cash. Examples are if the firm issue common stock to purchase assets. So there's no cash involved here. Basically, the firm's common stock increase and the asset account, non-cash asset account is going to increase. Conversion of bond into common stock. So bond decrease, common stock increase. Direct issuance of debt to purchase asset, debt increase, non-cash asset increase. Exchange of plant assets. So basically, PP&E, one kind of PP&E increase, the other kind of PP&E decrease. And those are examples of non-cash transactions. As we mentioned before, so those kind of non-cash transactions, you are either going to see it at a separate schedule at the bottom of the statement of cash flow, or sometimes the firms are going to report it in a separate note or supplementary schedule to the financial statements. So sometimes you're not going to see it on the bottom. You are going to see it somewhere else as a separate schedule to the financial statement. But those kind of activities, they need to be disclosed somewhere on the firm's financial statement. So how to prepare the statement of cash flow? As we mentioned at the beginning of the class, there are two methods to prepare the statement of cash flow. One is called direct method. The other is called indirect method. And what are the differences between the two? So here is an example of, it is for the same firm, same period. The cash flow statement, one is prepared under the direct method. The other is prepared under the indirect method. And I want you to spend some time look at those two statements. And please tell me what are the similarities among those two statements and what are the differences between those two statements. You can pause your video for now. So what are the similarities and differences between these two kinds of statements? If you look at these two statements, there's actually a lot of similarities. So for example, cash flow from investing activities, and this is cash flow from, cash flow from operating activities, 172,000, 172,000. Cash flow from investing activities, it is a cash outflow of 141,000. 141,000. Cash flow caused by financing activities is a cash outflow of 9,000. Cash outflow of 9,000. So the net change in cash, 22,000, which is basically 122,000 from operating activity, minus 141,000 from investing activity, minus 9,000 from financing activity, and that's going to give you 22,000, which is an increase in cash. Cash at the beginning of the period, 32,000. Cash at the end of the period, 55,000. And non-cash activities. So the firm issued bond to purchase land, and bond increased by 110,000, land increased by 110,000, but it doesn't involve cash. So we put it at the bottom of the statement of cash flow, 110,000. And if you look closer, so actually anywhere after this line, and it is here, those are exactly the same between those two statements. For the cash flow from investing activities, so the firm sell equipment, which bring cash inflow of 4,000. Sale of equipment. Purchase of buildings, the firm spent 120,000 to purchase buildings. So purchase of buildings, 120,000. Purchase of equipment, the firm spent 25,000 to purchase equipment. So it's a cash outflow of 25,000. And for the financing activities, the firm issued common stock, which bring the firm cash inflow of 20,000. So issue of common stock. Payment of cash dividend, the firm pay out dividends through cash, and it used out cash of 29,000. 29,000. So anywhere after the net cash flow from operating activities, those are exactly the same between the two statements. So the only difference happens here. How are we presenting the cash flow from operating activities? So that's actually why we're talking here, the direct method, indirect method. It is only the only difference is for cash flow from operating activities. Cash flow from investing and financing activities, it doesn't affect it by whether the firm is using direct or indirect method. So exactly what is the firm doing differently between direct and indirect method for cash flow from operating? As you can see here that under the direct method, it is really a very direct way of telling you how is the firm spending money or how is the firm getting money during the period from its core business. The firm get cash receipt from customers, and the firm spend money to pay its suppliers, for operating expense, to pay tax, to pay interest. So that is really a direct way of telling you directly how is the firm spending and making money. Versus the indirect method, it is not that straightforward if you look at it. So it starts from the firm's net income, and then it is going to make some adjustment to reconcile the firm's net income to cash flow from operating activities. So specifically, we need to add back those depreciation expense, loss on disposal of plant asset, because this depreciation expense, it is decreasing the firm's net income, but it doesn't affect the firm's cash flow. the same as loss on disposal of plant asset. And then we are going to do some adjustment for those accounts. Those are basically the firm's balance sheet accounts. And then if you look more closely, those are the firm's non-cash current asset accounts. We're going to adjust those according to whether they are asset or whether they are liability, whether they increase or decrease. We're going to talk about it in more detail very soon, like in the later part of today's class. But this is just in a nutshell, what is the difference between the two. And specifically for the direct method, it shows cash receipt and payment directly. And the common categories, the firm may collect cash from customers. It may collect cash by getting interest, dividend received. Other operating cash receipts, cash paid to employees, other suppliers, pay interest, pay tax, and other operating cash payment. And versus indirect method, we usually start from the firm's net income. And we make some adjustment to arrive at net cash flow from operating activities. And what kind of adjustments are we going to make? We're going to talk about it shortly. But before we get into that, do you have any guess that which approach is used more commonly by companies? Which approach is used more often? Is it direct method or indirect method? So actually, indirect method is used more often. 98% of the firm use indirect method. And what is the reason for that? So it's mostly because indirect method, it is actually easier and less costly to prepare. So as we are going to show in a minute, if you have the firm's income statement, if you have the firm's balance sheet, and if you have a little bit additional information, you can make a statement of cash flow. Versus if we are using direct method, usually we need to look at the firm's cash account. The firm is going to have a lot of transactions during the period. And then we need to go through all of those transactions and classify them according to the nature of those transactions. So that is usually more costly. Versus indirect methods is usually easier and less costly. And also it provides us with a reconciliation between the firm's net income and cash flow from operations, which are sometimes very useful. So how to prepare a statement of cash flow under the indirect method? Because indirect method is used more often. So in this class, we are going to talk about the indirect method. If you are interested, once you go to take accounting 301 or intermediate financial accounting, they're going to talk about direct method as well. So the first step in preparing a statement of cash flow under the indirect method is to prepare the cash flow from operating activities. And under the indirect method, we start from the firm's net income, and we make three types of adjustments. What are those three types of adjustment? First, we need to add back all of the non-cash expenses because they decrease the firm's net income, but it doesn't affect the firm's cash flow. And examples for those are depreciations, amortizations. And secondly, we need to take out gains and add back loss that result from investing and financing activities. So for example, sometimes the firm may sell a machine at a loss. And then because this is a result of the firm's investing activity, so we need to deduct any gain or loss from the firm's net income, which result from that kind of activities. And lastly, we need to analyze change to the firm's non-cash current asset and current liabilities account, except investment. And we need to deduct any increase in current asset and add any decrease in current asset. we need to add any increase in current liability and deduct any decrease in current liability. So this is how to prepare the cash flow from operating activities. And the second step is to prepare cash flow from investing and financing activities. So basically, we need to analyze the change in investment, non-current assets, non-current liability accounts, and stockholders' equity accounts. And the last step is to calculate the net change in cash, which basically we add the firm's cash flow from operations, cash flow from investing, and cash flow from financing. And then we're going to get the net change in cash of the firm. We need to compare it with the change of cash balance on the firm's balance sheet. And those amounts need to agree. So, and then lastly, don't forget to list the non-cash activities. So as you may have seen here, how to prepare a statement of cash flow. There may be it seems like there are lots of rules to remember here, especially for the cash flow from operating activities. So is there any easier way to do it? Is there any easy steps to follow? And luckily, yes, there is. And if you don't want to remember all of the rules that I talked about in the past 1 minute, here's a slightly easier method that I'm going to teach you. If you still remember and here is the core of this method. So if you still remember that at the beginning of this semester, we talked about the accounting equation, which is asset equals to liabilities plus stockholders' equity. And then if you decompose assets, asset can be cash or non-cash. So, and then if we move the non-cash part to the right-hand side of this equation, and we take the change of all of the accounts, this is going to give us the change in cash is going to be composed of the change in liabilities plus the change in stockholders' equities minus the change in non-cash asset. And furthermore, the change in liabilities, it can be decomposed of current liabilities and non-current liabilities. The change in non-cash asset can be decomposed of the change in non-cash current asset, except investment. It can be decomposed of investment and long-term asset. So, and basically with the next thing we need to do, because now we know that as long as we take care of the change in all of those categories, we're going to get something which is exactly equal to the change in cash. So the next thing we need to do is basically we need to figure out that those kind of change, how much of which of those are related to operating activity, which of it is related to the firm's investing activity, and which of it is related to the firm's financing activity. And the general rule of thumb is basically the firm's, so asset, liability, stockholders' equity. And within asset, we have the firm's current asset and long-term asset. Within liabilities, we have the current liability and long-term liability. And within current assets, we have cash, we have investment, and we have anything which is non-cash except investment. So cash, we don't need to consider this. Basically, we need to classify everything else. And all of the firm's non-cash except investment and the firm's current liability, those are usually operating related. And the firm's investment and long-term assets, those are usually investing related. The firm's long-term liability and stockholders' equity, those are usually financing related. The reason I'm saying those are usually, it is because there are some exceptions, and for some of our accounts, we need to decompose them. So for example, the firm's long-term asset, how about depreciation? Depreciation is something we need to take out in the operating section of the firm's cash flow from operating activities. So it's not always the same. There's just a few exceptions. Usually the accounts we need to look at, those are the firm's long-term assets and the firm's retained earnings. Those accounts we need to do some decomposition. The way we do it is we need to decompose those accounts and figure out what is the numbers that relate to the other activities. But as a general rule of thumb, if it is non-cash except investment, current liability, all current liability, those are operating. Long-term assets, investment, that are investing. Long-term liability, stockholders' equity, that is financing. So that is a general rule of thumb. So what is the slightly easier method? We can summarize it into several steps. First step, calculate all of the change in non-cash balance sheet account. The second step, explain or decompose the change. So usually the special attention, the accounts we need to decompose are long-term asset and retained earning. The third step, classify the change as operating, investing, financing, or long cash. And the last step, prepare the statement of cash flows. So in order to give you a more concrete idea how we do this, let's look at an example. Here is an example of how to prepare a statement of cash flow under the indirect method. So we have the firm's balance sheet. So here we have the firm's balance sheet, the firm's income statement, and some additional information. And the first step we do is we need to calculate all of the change in non-cash balance sheet account. So in order to explain the change, one way is we just directly look at what is causing, we look at its T account, what is causing the increase and decrease. But the other way is we look at everything else because the balance sheet, it needs to balance. So if cash increased by 22,000, everything else, they must to kind of at a credit side of 22,000. So the first step, we calculate the change in all of the other accounts. So here we can just look at directly at the answer. And this is a decomposition of the cash account. The change in cash can be decomposed into those three parts. And this part is usually the change in current liability, change in non-cash asset except investment. Those are usually operating. The second part is usually investing. The last part is usually financing. And after we have done that, we need to do some explanation and decomposition of some certain accounts. And specifically, so here, what we usually do is we look at the additional information here. Depreciation expense, let's just look at each of them. Depreciation expense composed of 6,000 for buildings, 3,000 for equipment. So basically here is this account. Depreciation, buildings, 6,000 increase. So that's good. depreciation for equipment, 2,000 increase. But here it is saying 3,000 for equipment. So what is happening here? So now we need to do some decomposition. Let's decompose the accumulated depreciation for equipment. The beginning balance is 1,000. The ending balance is 3,000. And we know that the firm incur 3,000 depreciation expense for equipment. So there's 1,000 difference, and where is it coming from? So let's keep reading. The firm sold the equipment with book value of 7,000, which cost 8,000. Let's depreciate accumulative depreciation of 1,000 for $4,000 in cash. So basically, this is telling me that because the firm is selling this equipment, so it has to return off the accumulative depreciation of 1,000, which is associated with the sale of equipment. So, okay, now it makes sense because the firm has a debit side of it has to return off accumulative depreciation for equipment for 1,000. And then, so this information, it is also telling us, hey, the firm sold the equipment with a book value of 7,000, which cost 8,000. So let's decompose the firm's equipment account. Beginning balance 10,000, ending balance 27,000. Beginning balance 10,000, ending balance 27,000. And the equipment account increased by 17,000. So what is causing the increase in equipment? We know here that the firm actually sold 8,000, sold that equipment with a cost of 8,000. So it decreased the equipment account by 8,000. And then if we keep reading of this additional information, issued 110,000 long-term debt, long-term bond in direct exchange for land. So after reading this information, we know, hey, so this is a non-cash transaction. And a building costing 120,000 was purchased for cash. So hey, so here you go, like 120,000. This explains the increase in building account, and the equipment costing 25,000 purchased for cash. So this is explaining why the equipment account increased by 17,000, because we have a cash purchase of 25,000, and then it is decreased by 8,000. However, one thing to pay attention is the equipment, even though it decreased 8,000, the firm only received 4,000 in cash. And then the rest is we need to write off the firm's accumulative depreciation. And then it is a loss for the firm on disposal. So basically for this 8,000, we need to further decompose it into the cash sale of 4,000. And then accumulative depreciation of 1,000. 3,000, which is loss on disposal. And if you look at this 1,000 and this 1,000, it actually cancel off. And then if we keep looking here, issue common stock at par for 20,000. So yeah, so this basically tells us, hey, so this is a cash, the firm get cash inflow from this increase in common stock, and declare and pay dividend of 29,000. So here we need to decompose this account, retained earning, this 116,000, and specifically the beginning balance of retained earning is 48,000, ending balance 164,000, and the increase in retained earning, it is coming from 145,000 net income, and it is reduced by 29,000 of cash dividend payment. So that is step 2. For some certain accounts, most typically the firm's any account which related to the firm's long-term asset and also the firm's retained earning. We need to decompose those because the change in those accounts, those are not straightforward. So for example, the change in accumulative depreciation here, 3,000 is due to depreciation. We need to add it back in cash flow from operating activities. And for the change in equipment here, we have a purchase of 25,000, which is a cash outflow, and the firm sold equipment, which brought the firm cash inflow of 4,000. And then there's 3,000, we need to add it back from the operating part of the cash flow from operating part. So without such decomposition, we won't be able to separate out those cash flows so easily. And also the same as here, retained earning part. So net income, this is actually cash flow from operation, and dividend paid, that is cash outflow from financing activities. So the change in retained earning is not like 100% like cash flow from financing. Actually, part of it is driven by net income, which is an operating activity. So after we have done the decomposition, we need to move to step 3, which is classify the change as either operating, investing, financing, or non-cash. So if you look at step 3 here, any of the change in, so the firm doesn't have any investment here. If you have investment, that is usually investing activity. But because the firm doesn't have investment, so account receivable, changing inventory, changing prepaid expense, those are typical operating activities, as well as account payable, income tax payable, those are operating activities as well. And as we said before, the change in land for this one, because it is financing by the issuance of bond, so there's no cash involved. That is a non-cash transaction. The firm's buildings, so as we analyzed before, the increase in buildings, that is just because of the firm purchased that building. All of it is because of the purchasement of building. So that is straightforward there, an investing activity. And then the equipment. So the change in equipment, so that is investing activity. We also need to dig out this actually some operating activities here as well, that we have like done the decomposition, and then we need to, if you still remember part of it, it is driven by decomposition, which is reflected on the income statement, and we need to add it back in the operating part of the cash flow statement. And then the accumulative depreciation of building, that is 100%. Actually, not 100%. Yeah, that is 100% operating. That is 100% driven by the depreciation expense, which needs to be added back in the operating section of the cash flow statement. And depreciation from equipment, that part of it is depreciation. Part of it is because of a disposal of the equipment. Common stock, it is a financing activity. And retained earning, as we have done the decomposition, net income part is operating, and dividend payment, that's financing. So after we have done the classification, we put those items in different parts of the firm's statement of cash flow. So for example, here, we start from the firm's net income, and then depreciation expense, loss on disposal of plant asset. Depreciation expense, we have 6,000 here, plus 3,000 here. And disposal of plant assets, we have 3,000 here. And everything else, we just take it directly from the firm's balance sheet, the change in those accounts. And then cash flow from investing activities. Purchase of building, 120,000. Purchase of equipment, 25,000. Sale of equipment, 4,000. So actually everything is going to find a home on the firm's cash flow statement. Issue of common stock, 20,000. Payment of cash dividend, 29,000. And then, so the total cash flow from operating activity plus the total cash flow from investing activity plus the total cash flow from financing activity, it's going to give you a net change in cash. And it's going to be equal to the difference between the firm's cash at the end of the period and cash at the beginning of the period. And if you look at this 33,000 is going to be exactly equal to the firm's cash balance on the firm's balance sheet at the beginning of the period. And this 55,000 is going to be exactly equal to the firm's cash balance on the balance sheet at the end of the period. And at the end, we need to disclose the non-cash activities, 110,000. So this is how to make a statement of cash flow. And I would strongly encourage you to use the blank, like the blank file, and try to hide all of the answers and try to go through this example on your own. And if you have any question, feel free to send me an email.